People think institutional data is the ultimate truth in trading. They believe if big money is buying, the market must go up, and if big money is selling, the market must crash. But this belief is dangerous. Institutional data does not always tell the full truth, and blindly trusting it can slowly kill a trading account. Institutions do not think like retail traders. Their goals are different. They don't chase quick profits from small moves. They manage huge amounts of capital, and because of that, they cannot enter or exit the market in one single order. Their positions are built slowly, sometimes over days or weeks. So what you see as buying or selling is often just one phase of a much bigger plan. Another important thing is that institutional data is always delayed. By the time it becomes visible to the public, the smart money may have already changed its intention. Retail traders look at the data and enter late, thinking they are following the big players. In reality, they are often providing liquidity for institutions to exit their positions. Institutions also use misleading behavior. They don't want the crowd to know their true direction. Sometimes they create fake buying pressure to attract retail traders, only to sell into that demand. Other times, they show heavy selling to create fear while quietly accumulating positions in the background. The data looks bearish, but the intention is bullish. Another mistake traders make is assuming institutions are always right. Institutions are powerful, but they are not perfect. They hedge, they adjust, and they accept losses too. Sometimes their trades fail. Sometimes they change plans due to new information. If you treat institutional data as a guarantee instead of a probability, you stop thinking independently. Market structure matters more than raw institutional numbers. If price is not confirming the data, something is wrong. Price is the final truth. Institutions can hide intentions in data, but they cannot hide price forever. When price and data don't align, trusting data alone becomes risky. Retail traders also forget one thing. Institutions trade against emotions. They benefit when retail traders are confident at the top and scared at the bottom. Institutional data often increases that confidence or fear. That's why relying only on it can push you into emotional decisions instead of logical ones. The smart approach is not to ignore institutional data, but to question it. Use it as context, not as a signal. Combine it with price action, risk management, and patience. Ask yourself who benefits if you take this trade based on this data. In trading, survival matters more than prediction. Institutional data can be useful, but it is not a holy truth. The moment you stop worshiping it and start analyzing it critically, you move one step closer to trading like a professional.